Moody's lead analyst on South Africa. She joins us on the line from New York. Good evening to you. Well, I guess earlier for you, Kristin. Firstly, I have to ask you about the news that came out this afternoon. Talks are collapsing. There's still a CCMA process, but it looks like a strike in the gold mining sector more likely. How dire is that for South Africa and our rating?
I don't expect to have any direct impact on the rating. It's another example of the very strike-prone labor market that you have in South Africa, and it is responsible for substantial increase in the working days lost to strikes in the last couple of years. Last year we had the very long 5.5-month strike in the platinum sector. Now it may be gold's turn. I would expect that no strike would last as long as last year's did, but I think it's too early to tell just how far apart these sides are, in spite of how long they've been negotiating.
Obviously, yes, we're speculating if there is a strike, would that make investors even more nervous? And of course, there's always the possibility of more job losses. We've seen announcements of massive retrenchments across our mining sector.
No, indeed. The sector has been plagued by a number of strikes and differences of opinion in recent years, and that has led to a number of discussions even between governments, the mining sector and mining officials, and the workers' representatives that have been difficult to reconcile. They each seem to be talking from a different playbook.
All right, some concern there. Let's move on, Kristin. I know you can't speculate too much, but part of the woes for our miners is, of course, China's slowdown. We rely on that market, and things looking better today. Markets certainly looking better, but surely this doesn't mean that all China's problems have suddenly gone away, I guess.
Well, the problems that China is facing are kind of growing pains. They're trying to, or they're going through a change from a predominantly export-oriented economy to one that relies more heavily on consumers. And as that happens, of course, there are going to be what I call growing pains. And as a consequence, settling down in this environment to a particular price, like the exchange rate, can take some time to work out. China doesn't have the experience of working with a market-determined exchange rate the way that South Africa has become so accustomed.
That doesn't sound too bad, Kristin, growing pains. So it's not the picture of gloom and doom that some people is behind that curtain. China doesn't let us into a lot of its decisions. Just outline what you think this means this year for South Africa, for our economy, for our rand.
What we've seen already last year was a rather significant reduction in South African exports to China. China went from being the largest single trading partner, if you count the EU as one trading partner, and has dropped considerably last year. And that will continue as long as demand for the principal products that they used to import from South Africa continues. As a consequence, we would expect that as long as the commodity super cycle, the death of this commodity super cycle continues, that we will be in a situation where South Africa will have to look elsewhere for demand for its products. And I think that's one reason why local entrepreneurs are looking so avidly at the rest of the sub-Saharan African region. There, they export mainly manufactured products, and that is where they have an edge in the region.
All right, thank you very much, Kristin Lindow from rating agency Moody's on the line from New York.